If you go back and you look over last month's presentation, we had a lot of the developments that we were talking about happen. We didn't expect them all to happen in 1 month, but they kind of did, or really 1 week. So, we had what it looked like uh, the Fed saying, okay, we're going to cut rates. And it looked like Trump was going to be a shoe-in. That looked good for small caps. Small caps did not break out to new highs, though. They broke out of a range, but they couldn't make new highs. And then we had a growth scare, and we had the unwinding of the yen carry trade that we've been talking a lot about. So really, if you go back and take a look at what we were talked about last month, and we've had a lot of it develop. So first of all, what I want people to see here a little bit is how highly the yen carry trade unwind has correlated with the decline in the Nikkei and the decline in the NASDAQ. Okay, so what that means likely is a lot of people, remember, you could borrow yen at almost zero interest rates. So everybody in the world was borrowing in yen and buying higher yielding currencies or buying assets that were appreciating. We saw the peso fall apart, and we saw a lot of things fall apart. So starting off, this really started when we got the breakout in the yen. Remember, we talking about this 160.35. It's a 35-year high. We broke out. We started to follow through. And then we got the first of double-barreled large intervention from the Bank of Japan. Now, notice that the day that we decline dollar yen right here in this top panel declines back below that breakout zone. That's the high in the Nikkei, and the NASDAQ starts declining with the dollar yen. Okay, then we get a round of intervention. We get another round of intervention, and that just accelerates the decline in the Nikkei and in the NASDAQ. Notice when we kind of stall in dollar yen, we get a little bit of recovery in the NASDAQ, get a consolidation in the Nikkei. As soon as we turn down again, market turns down again. Extremely high correlation here. Okay, so we're getting some unwind. We're also getting a bunch of things that added to this. So we got double-barreled intervention here. Then we got some other things that we're going to talk about. We got, first of all, the Feds saying, okay, we're pretty sure we're going to cut in September. Okay, so that means lower interest rates in the United States. That unwinds the dollar yen, because the dollar yen is based on the dollar being a much higher spread currency in terms of yield. So when that yield comes in, the spread comes in. And then we got growth scare, and that's what really spooked the market. And that was mostly Thursday and Friday. Now, we talked about how for the narrative that we have, the real threat is a growth scare. And we've got stuff out there that we've had for a long time saying there's a potential recession, right? And we had some evidence of slowdown and some evidence of some other things. And then so we had really negative PMI report, had really negative jobs growth, and then the NFP report confirmed a slowdown, the unemployment rate up 2.2%, and triggering the SOM rule that we talked about as one of the things that could unwind a soft landing is an unemployment cycle. So let's kind of take a look at all that. So first of all, just see how highly correlated this dollar yen decline was with the market decline in the Nikkei, which is actually the most sensitive to it, and in the NASDAQ and the tech stocks. Okay, the next thing we got is we got initial claims. Initial claims, we've been talking about how one of the kind of growth scare concerns that we get typically before recession, initial claims rise to around 250,000 or higher. We got initial claims at 249,000 on Thursday. That's pretty much there. So that's kind of a recession warning from initial claims. Now people are getting concerned about an unemployment cycle. Continuing claims also rose, although a lot of that seems to have come from Texas, and we'll see how it turns out. Okay, and then Thursday morning's manufacturing PMI came out, was very much lower than expected, fell to 46.8 from 48.5. Remember, anything under 50 is contraction. So that's a deep contraction, but a part of that report, that ISM manufacturing, was really negative, and that was the employment index. So remember, traders are already nervous about an unemployment cycle because initial claims were at recession levels. Now we see that ISM, PMI, completely separate entity, completely separate everything. The employment index fell by an extremely sharp amount to levels that matched prior recessions. It fell by 5.9 to 43.4. Okay, so we look at these things and they're all pointing to recession. So now we have 3 reports boosting growth fears, which is a big potential Achilles heel of the soft landing narrative. Okay, and then after that, on Friday morning, right after all that, after an 80% down volume day on Thursday, we get the NFP report coming out, and what do we see? We see payrolls way under expectations, and we see unemployment up higher than anybody estimated, clearly triggering the SOM rule, which has called basically recessions in the past. So now the market is concerned about a growth problem, either a severe deceleration or a recession. We can see the SOM rule triggered, and we can see how every time that it triggered in the past, we had problems for stocks and we had interest rates come down. Then the other thing we had that also pointing to recession, we had the 210 yield curve almost uninverting. And remember, we were talking about when we look at that yield curve uninverting, that's a recession sign. Usually within 6 months of recession, and often immediately you get a recession. And the other thing to look at is, why is it uninverting? Why is it steepening? Is it because short rates are falling faster than long rates? And if it is, that's usually a more reliable indication of a severe growth deceleration. And that's what we've had. We have almost an inversion, but an incredible steepening in the yield curve because short rates are coming down so sharply. And to confirm that, the bond market broke out of this little head and shoulder bottom right here and started to take off. And now you have targets 102, 110 at least. And if we get a recession, could be more than that. So now bonds are the asset to run to. Stocks are the assets to get the hell out of, particularly growth stocks, but even more so, small caps. They're the most sensitive to growth. Okay, and we can see the VIX also spiked to levels that we haven't seen since the 2022 sort of mini bear market. And we have tensions in the Middle East, right? Israel beat its chest about having basically sent a missile all the way across the country of Iran and bombing a single room to kill a Hamas leader. And before that, it killed a Hezbollah leader. So we have 3 entities now that are vowing revenge or retaliation against Israel. We have Iran, we have Hezbollah, we have Hamas. Yeah, they're all connected. And over the weekend, there were rumors of meetings by Axis powers, North Korea, Russia, etc., all these, even China, that were seeking to help Iran potentially in its retaliation against Israel. So we had a few analysts come out on Sunday and talk about, this is World War III, baby. So people are nervous. There's a lot of reasons to be nervous. And then, of course, Sunday night, NVIDIA added to the downside parade by announcing its production of this big Blackwell chip that's going to be the game changer. It's going to have to be delayed for months because of a design flaw. So now we're starting to get some AI disappointment too. Okay, and so to look at the very broad-based NICE index, we had a breakout and we had what we call back into the range. Came back into the range on an 80% down volume day. That's a very negative signal.
Same thing with the small caps. Here's the longer term picture. Remember, small caps broke out of a base, but then they got into this resistance from the 2021 highs, and they weren't able to surpass it. Then we had our back into the range, back below the 50 DMA today, and on high volume, and back closing below the HVN of the prior range. That's very negative. And remember, the breakout of the range happened because we thought rates are going up and the economy's still holding on. And the back end of the range happened on growth concerns, and small caps are going to be the most sensitive to growth concerns. About 40% of small caps don't make money. So if we don't get more growth, if interest rates don't come down, they're going to be hit by that harder than anybody else. Okay, and what we've been watching, these wedges in the S&P and in the NASDAQ, and noting that they were happening, talking about watching for a breakdown. We did get a breakdown in both of those. And look what happened to tech, right? Tech had a run after a breakout, relative strength kind of double topped and turned down, and then it fell apart, right? And this is really very highly correlated with that yen as well. And we had some divergences and things at the top. Now we're testing today. We tested pretty much to the tick the lows from March, April, and got a bounce off of it. But this is a big enough decline. We broke down in relative strength that I can pretty much say techs are not going to be the leader of any recovery rally, at least not initially. Gold is sensitive to recession too, but gold has done pretty well, right? And gold often does better than stocks in recession. We were down today, but not a lot. And we're still really kind of holding really this HVN of this prior range is really kind of the key support here around the 50-day moving average, a little lower. If as long as we can hold that, the bull market is completely intact and showing a very good relative strength. And you can see relative strength versus the S&P is taken off in the last week. The S&P is into some support though, right? So we broke down, we got kind of a head and shoulder here, we got a wedge breakdown, got a lot of things. We're actually pretty close to those targets. So, and we are into, here's your former correction. We're into the HVN of that former correction and bouncing off of it today. And here's that 200-day moving average. So somewhere in here, probably we're very much overdone on a near-term basis, probably get some kind of a consolidation or bounce. And we really want to watch the character of that to figure out we got a lot more to go or a little more to go in the terms of the correction. All right. So we've had a lot of things that we were trailing stops on in PSL over really since March, April, right? And so we've really toned down, and now we're pretty lean and mean in that portfolio, although we took a bit of a hit last month, but we haven't given back everything, and we're really ready for if we get a correction over. And are we looking for a correction over, or are we looking for an intermediate term decline? And that really, I would say that the jury is still out. We did have a intermediate term warning that came on some marginal stuff, and it didn't really look like the weight of evidence of technicals were with it. Turned out that it was decent, but certainly by Thursday, you got some confirmations that that was starting to develop. And certainly by Friday morning, you had all of them. The major internals are not looking like a major top. Some of them are. There's the NYHL has had months of divergence, so that's a problem. And so has net points. So those two are potentially at a lot of divergence. That's arguments for more of a major correction or even possibly a bear market. But the breadth indicators are all have recently made new highs. The McClellan-Nice ratio adjusted summation index has been over 500 on these highs. Those things argue it's very rare. Really only had
one bear market start from anything close to this level of breadth performance since 1920. So it's very rare indeed. And we do have divergences and things, but we really don't have breakdowns in the supply, demand, and spread indexes. They're in mixed according to their moving averages, which is consistent with the correction. They're not really breaking. You don't see demand breaking down. You don't see supply breaking out. You don't see the spread breaking down. We'll watch for that. If we get more of that, and of course we don't have the today's numbers in here, but it's not going to be, it's going to be a hit, but not a huge hit. So we're really going to be this watching the plurality of internals and technicals to try to figure out what kind of a correction we're in, or whether it's actually turning into recession and bear market. The other thing I wanted to point out here, that this is kind of a good chart. This green line is what actually happened to Fed funds, and these dotted lines are what the futures market projected would happen. And I just want you to see, although we often discuss, okay, futures markets and swaps are projecting 3 cuts by the end of the year and that kind of thing, because that's a part of the narrative. That gives you a good idea what people are expecting that leads to current price structure. So it's important to analyze, but I do want you to understand that the market has a horrendously bad, only thing worse than the market is the Fed in terms of projecting what Fed funds and interest rates are going to do. So realize that, when rates are staying low, the market thought they were going to be going up. When rates were going up, the market thought they were going to continue to go higher, etc. So yes, we want to analyze what the futures markets are projecting to know what the narrative is right now, but we also want to realize that that narrative is almost always wrong.